Most people do not fail at investing because they lack intelligence. They fail because they misunderstand what investing truly is. They think it is speed. They think it is excitement. They think it is prediction. It is character. It is temperament. It is a quiet discipline to do almost nothing while the world around you is doing everything. For decades, the financial world chased complexity. Wall Street built towers of noise, charts flashed across screens. Experts argued about trends, forecasts, and the next economic shift. And in the middle of that chaos, one investor quietly demonstrated something radical. He showed that investing is not about outsmarting everyone else. It is about outlasting them. And that idea changed the way serious investors think about money forever. Because when you truly understand what he practiced, something shifts inside you. You stop chasing, you stop reacting, you stop trying to win every day. Most people remain financially stuck, not because they earn too little, but because they think too short. They approach money emotionally. When markets rise, they feel invincible. When markets fall, they feel fear. They buy when others are euphoric and sell when others are terrified. Their decisions are not based on value or logic. They are based on mood, and mood is the most expensive advisor in finance. There is also the employee trap. Many people are trained to exchange time for money. They are rewarded for effort, not ownership. They focus on promotions, salaries, and lifestyle upgrades. Each raise becomes a new car. Each bonus becomes a vacation. The income rises, but so does the expense structure. They run faster, but remain in the same place. Investing, in contrast, requires a different mindset. It requires you to shift from earning to owning, from consumption to accumulation, from today's pleasure to tomorrow's security. But that shift is uncomfortable, because it asks you to delay gratification in a world that sells immediacy. It asks you to look boring in a culture that worships excitement. It asks you to think independently in a society addicted to consensus. It asks you to think independently. The average person checks stock prices daily. They read headlines obsessively. They react to economic predictions. They seek reassurance. They want certainty. But certainty does not exist in markets. And the desire for it is what causes most mistakes. The philosophy that transformed investing did not rely on complex algorithms or constant trading. It rested on a simple but profound principle. Buy a piece of a real business at a fair price. Hold it for a very long time. Allow time to do the heavy lifting. That is it. It sounds almost too simple. Yet simplicity is powerful when it is paired with discipline. The core shift was this: treat stocks not as lottery tickets, but as ownership stakes in real companies. When you buy a share, you are not buying a ticker symbol. You are buying a portion of a business that sells products, employs people, generates profits, and compounds value over time. Once you internalize that idea, your behavior changes. You no longer panic when the price drops temporarily, because if the underlying business remains strong, the temporary decline is not a disaster. It may be an opportunity. You no longer feel the urge to trade constantly, because ownership is not meant to be flipped every week. It is meant to be held while value grows quietly in the background. This philosophy also demanded emotional control. Markets move up and down every year. Recessions happen, bubbles form, crashes occur, but human nature remains constant. Fear and greed cycle endlessly. The investor who wins is not the one who predicts every cycle. It is the one who remains rational during them. Consider the power of patience. Many investors believe wealth is created through activity. They feel productive when they trade. They feel intelligent when they react quickly. But long-term wealth is often created through inactivity, through waiting, through allowing strong businesses to compound earnings year after year. Compounding is not dramatic in the beginning. In the first few years, progress feels slow. Gains appear modest. It may even feel disappointing compared to speculative trends that promise quick returns. But compounding is a force that rewards consistency. A business that grows its earnings steadily for 10, 20, 30 years creates exponential value. Dividends are reinvested. Profits expand. Small percentages stack upon each other until they become meaningful sums. The investor who understands this does not chase sudden spikes. They protect their capital. They choose quality. They wait. And waiting, in this context, is not passive. It is strategic. Another lesson that reshaped investing was the focus on understanding. This seems obvious, yet it is rarely practiced. People invest in industries they cannot explain. They follow trends they do not analyze. They rely on the confidence of others instead of their own knowledge. But clarity creates conviction. When you deeply understand how a company makes money, who its customers are, what risks it faces, and why it has a competitive advantage, you are less likely to panic during volatility. Knowledge reduces emotional turbulence, and emotional stability is a competitive advantage in markets. There is also the principle of margin of safety. No investment is risk-free, but risk can be managed. If you buy a strong business at a reasonable or discounted price, you create a buffer against mistakes and uncertainty. You do not assume perfection. You assume imperfection and prepare for it. This mindset is conservative, but not fearful. It acknowledges reality. It respects uncertainty and it builds resilience. Many investors lose money not because their ideas were terrible, but because they overpaid. They allowed excitement to override valuation. They bought into narratives instead of numbers. The philosophy that changed investing emphasized value over story. It prioritized fundamentals over headlines. It rewarded analysis over emotion. Then there is the idea of concentration. Modern advice often promotes extreme diversification to reduce risk. While diversification has its place, over-diversification can dilute conviction. It can turn investing into a collection of average ideas. The transformational approach encouraged investing meaningfully in your best ideas once you have done deep research and understand the business. Not recklessly, not impulsively, but confidently. Because spreading yourself thin across dozens of mediocre opportunities may protect you from large losses, but it also limits the potential for meaningful gains. Focus requires courage. Courage requires preparation. Preparation requires patience. Another critical lesson is the rejection of leverage and unnecessary complexity. Debt can amplify returns, but it can also amplify destruction. When markets fall, leverage turns manageable declines into catastrophic losses. The disciplined investor respects risk. They avoid situations where one mistake can erase years of progress. They prefer steady growth over fragile acceleration. This is not flashy. It does not make headlines. It does not satisfy the desire for rapid transformation, but it builds durable wealth. Over time, these principles create a profound internal shift. You begin to see market downturns differently. Instead of fearing them, you view them as natural cycles. You keep cash available. You prepare in advance for opportunities. You stop reacting to daily noise. You start evaluating annual performance. You measure success not by excitement, but by consistency. And slowly, almost invisibly, your relationship with money changes. You no longer feel controlled by it. You feel aligned with it. Imagine applying this philosophy for 5 years. You save consistently. You invest in businesses you understand. You ignore short-term volatility. You reinvest dividends. You avoid impulsive decisions. At first, the results may seem modest, but in the background, something powerful is happening. Compounding is building momentum. Year 6 feels different than year 1. Year 10 feels different than year 5. The numbers begin to reflect the discipline, but more importantly, your psychology has evolved. You are calmer. You are less reactive. You no longer compare your progress to speculative success stories. You understand that true wealth is built slowly and protected fiercely. By year 10, you may not be living extravagantly, but you will likely own meaningful pieces of productive businesses. You will have assets generating income independent of your daily labor. You will feel less anxiety about economic headlines. You will have options, and options are the true definition of financial freedom. The transformation is not only financial, it is personal. You become patient in other areas of life. You value long-term relationships. You prioritize health and learning. You understand that most meaningful outcomes require time. The philosophy of disciplined investing becomes a philosophy of living. It teaches restraint in a cult of excess. It teaches rationality in an environment of emotion. It teaches endurance in a world of instant gratification. And perhaps the most powerful shift is this. You stop trying to beat the market. You start trying to behave better than the average participant. Because in investing, behavior is destiny. 2 people can own the same stock. One panics and sells during volatility. The other holds and reinvests. Years later, their results are dramatically different, not because of intelligence, but because of temperament. This is the quiet revolution that changed investing. It redefined success from prediction to patience. It reframed risk from volatility to permanent loss of capital. It moved the focus from quarterly earnings to long-term intrinsic value. It showed that you do not need to be extraordinary to achieve extraordinary results. You need to be consistent. You need to be disciplined. You need to think differently from the crowd. The financial world will continue to evolve. Technology will change. Markets will expand globally. New industries will emerge. But human psychology will remain the same. There will always be fear. There will always be greed. There will always be speculation. And there will always be an opportunity for the patient investor to benefit from the impatience of others. If you internalize this philosophy, you will stop asking, how can I get rich quickly? You will start asking, how can I position myself to grow steadily for decades? That question alone can alter your financial future because it shifts your time horizon. And when your time horizon expands, your decisions improve. The next time markets fall, instead of reacting emotionally, you will remember that downturns are part of the cycle. The next time a speculative trend promises overnight gains, you will evaluate it through the lens of value and sustainability. The next time you receive a raise, you may choose to invest more rather than inflate your lifestyle. Small decisions, repeated consistently, compounded over time. This is how wealth is built, not through noise, but through clarity. The transformation does not happen in a single dramatic moment. It happens gradually. You read, you learn, you reflect, you adjust your behavior. You build habits aligned with long-term ownership. And one day you realize you are no longer anxious about money in the same way. You are not dependent solely on your next paycheck. Your investments are working quietly in the background. Your patience has become productive. Your discipline has become visible. And your future feels stable. That is the true impact of the mindset that reshaped investing. It democratized the idea that ordinary individuals with ordinary intelligence but extraordinary patience could achieve meaningful wealth. It replaced speculation with stewardship. It replaced excitement with endurance. It replaced short-term noise with long-term clarity. In the end, investing is not a battle against the market. It is a battle against your own impulses. Win that battle consistently and the results follow. Lose it repeatedly and no strategy will save you. The choice is subtle but powerful. You can continue chasing quick returns, reacting to headlines, and letting emotion dictate your decisions. Or you can adopt a philosophy rooted in patience, rationality, and long-term ownership. One path feels exciting, the other builds freedom. If this perspective challenged the way you see money, take a moment to reflect on your current approach. Are you investing or are you speculating? Are you thinking in months or in decades? The future you will inherit is being shaped by the decisions you make today. Choose wisely. Commit to learning. Commit to discipline. Commit to discipline. Commit to patience. And if you are ready to continue exploring serious, thoughtful approaches to wealth and financial independence, consider subscribing and staying connected to this conversation. Not for hype, not for shortcuts, but for clarity, because in a world of noise, clarity is power, and with the right mindset, time becomes your greatest ally.